Welcome everyone to TradeStation. This is Michael Burke. I'll be your host for just a short while here before we get David started. This is the third session in a four-part session that is covering portfolio backtesting using Portfolio Maestro. The reason that the slide says part 2 is that the first session was really an introduction to the whole concept, and then parts 1, part 2, and part 3 is David's a three-part series on how to build and backtest portfolios using Portfolio Maestro. So sorry for the confusion there, but this is actually part 2. There'll be one final session coming up in a couple of weeks, and so I'll put a link into the chat shortly so that you can sign up for that if you have not already. Let's get a little bit of disclosures out of the way and we'll get David started. Keep in mind that the following presentation is for educational purposes only. All the symbols and trading ideas discussed are for educational purposes and demonstration purposes and are not recommendations. Active trading is not suitable for everyone. Please read all of the disclosure information on the TradeStation website. I'm also going to put into the chat our disclosure document. Please take a look at that as well. So this second part will cover portfolio construction using Portfolio Maestro. For those of you who have not been to any of the previous sessions, they are archived and available for viewing on our website through the on-demand catalog on the TradeStation educational website. I'll also put a link into the chat to help you get to those resources as well. David has been a longtime friend of TradeStation. David is a commodity trading advisor. He manages large portfolios of futures. Basically, his expertise is in strategy backtesting and building portfolios of future trading strategies. So we're going to turn it over to David. David, it's all yours. And when we're done at the end, I'll give you guys some additional information on some of the upcoming events that will be hitting TradeStation in the next couple of months. So thank you very much for attending. David, it's all yours.
Great. Thank you, Mike. I certainly appreciate it. Okay, what we're going to be talking about today is kind of constructing the portfolio and then, for the most part, kind of evaluating the portfolio. As Mike had said, this is a little confusing, but part 2. But the first one was a primer that we did. It was kind of how to use Portfolio Maestro, what to click, how to create the different types of portfolios, how to apply the strategies, things of that nature, step by step as best as I could to kind of show you how to actually use the program. The one that I did last week, that was more along the lines of what markets do we want to put into the portfolio, what's the logic behind them, and kind of a discussion on walk-forward analyses when it comes to constructing a diversified portfolio, but really for the most part just looking at the individual markets and how to use a lot of correlation type models and some portfolio allocation type models, but kind of verifying and validating why it is that we need to have lots of markets into the mixture. And with this particular presentation, I'm going to be focused on constructing them and putting the numbers together and kind of showing you how to evaluate the actual portfolios that we're going to be looking at. And then just as a teaser for the next one, we're going to be talking about money management and, for the most part, stress testing a particular portfolio. But this is probably one of the more important ones, because once you have your systems together, you want to obviously bring things together and be able to evaluate. So we'll get right into it. Yet another disclaimer about who we are, what we do, things of that nature. And in this particular presentation, I'm going to talk about the power of Portfolio Maestro and kind of describe as best I can throughout the entire presentation really what's important to it. And later in some of the slides, I'll kind of make a reference between if you were to calculate things for yourself versus what you can actually do with the program. You'll see that taking an average versus actually putting a portfolio together can have very distinct differences. We'll also talk about strategies and baskets, and where we get these things from, how to put them together, the whole concept behind that. Obviously, we'll start to combine those baskets, or what I term as mini portfolios, into a larger portfolio. And then we'll spend the remainder of the presentation on some of the evaluation metrics, the good, the bad, the strengths, the weaknesses, just a ton of different types of tools that you can actually look at, which will help you to, one, obviously assess just how strong the portfolio is, but also how we can use those things to determine whether or not something should or shouldn't be added into the portfolio. And then, as we're technicians, I know I am a very visual type person, we're going to look at some of the different charts and graphs that are actually physically inside of the Portfolio Maestro program. So what is Portfolio Maestro, and what can we actually do with it? First is we can combine systems inside of the program. They're referred to as strategies, but essentially the same thing. And we combine them together, mixing and matching, adding, deleting, and really be able to bring all of those different components together and be able to see how they would have traded real time, one after another. So you're not just taking an average, you're looking at a new equity curve, a new trade-by-trade list that would actually show you just how good the portfolio is. And one of its real strong points is that we can then go in and say, well, maybe this one's not adding anything to it, or a particular strategy that wasn't all that good by itself, but combined into the portfolio, it actually has a very beneficial effect on the portfolio. So it allows you to mix and match and combine these things together. And in the end, I think that what you'll see is that a portfolio of diverse systems, diverse markets, is a really good starting point for a lot of what you'd probably use the program for. Second point is that there's some deep analytics. It really allows you to sort of dissect the portfolio, as well as the mini baskets, as well as the individual strategies that are actually in there. That'll allow you to really get a feel for the personality of the strategies, the mini baskets, mini portfolios, the baskets, I should say, and then the overall portfolio. And it will really allow you to get a feel for, does it meet with your personality type? Are you aggressive, but you have a portfolio that's slow and kind of boring to you, and therefore you might become bored with it and not trade it correctly? Or is it a high-stress type portfolio that's all over the place and not really perfect for a more subtle type trader? So that's really what the analytics will do. Now, not in this presentation, it's more of a teaser. Points 3 and 4 are what we're going to be doing in the next presentation, where we're going to stress test it, show you some of the tools that we actually have inside of the program that allow you to sort of play with variable settings, really just kind of go through and just determine if a portfolio with certain settings does such and such, has certain types of performance metrics, and then you make a subtle adjustment to it. Does the whole thing fall apart? So I show you how to stress things. And from that standpoint, we'll also go through the process of looking at some formulas that will allow us to improve the portfolio through the use of money management techniques, sometimes called position sizing, same thing. And in the next presentation, we're certainly going to go through that process of taking what we're building here today and take it to the next level by applying some certain types of money managements. So that'll give you an idea as to what we're talking about, one, in this presentation, as well as some of the other things we're going to be talking about in the next presentation. So the first slide, I want to at least kind of describe what a strategy is. I know some of you may or may not be necessarily new to TradeStation, but at least from the standpoint of Portfolio Maestro, what you want to do is you want to at least understand what a strategy is, and at least how I'm using it in this particular presentation. What we have here is, it almost looks like a target. If you see the after it says the making of a strategy, that little icon there, the cutaway is kind of what we're looking at that makes up that little icon, that strategy. So the red is the market, S&P, Euro, crude, whatever the case is, but it's an individual market. And what we want to do is we want to take a look at that, and we want to apply a strategy to it, or a style, if you will. And it can be trend-based, momentum, volatility, pattern-based, market characteristic-oriented, something that is distinct. Trend-based, like a breakout system, is probably a good example, or moving average crossover as a real simplistic idea. But we're going to take that strategy that concept, that style, and we're going to apply it to an individual market. The next step is that we're going to apply some type of a stop management, max adverse excursion, chandelier, parabolic trailing, or some type of a pivot level, something that allows you to have your system trade the way it wants to trade based upon, at least the way I operate, of a market-based reason to get into a trade. You would then have a market-based reason to exit that position, and while you're in that trade, you have some type of protective stop. So that's where the stop management will come from, and there's a wide variety of different styles that you can actually have. Then the final step is what time horizon. Intraday, are we dealing with dailies, weeklies? Sometimes people do monthly charts. But what you're going to have is you're going to apply it to a very specific time frame. And in doing so, what you'll have is a strategy all encompassed in one entity, one unit. And that unit is referenced by that little icon at the top there. And so what we want to be able to do is to have a number of these different types of strategies that come together, and it will allow you to actually combine multiple types of strategies together. Now, most of that, in fact, all of this is really done inside of TradeStation itself. It's something that you've probably become accustomed to in designing your systems. You take your indicators, your show me's, your paint bars, your visuals, and you eventually turn that into a system that tells you when to buy and when to sell. That's what this graphic is really talking about. The next step is to get a library full of these strategies. I've been trading from a systematic approach. I have literally thousands of systems that I work with, and what I would encourage you to do, even though that is a time-consuming process, a lot of people don't want to go through that particular process. Yes, max adverse excursion is MAE. I'll send you an article after the fact that will help to describe max favorable, max adverse. But what we have here is kind of a library full of strategies, and I would encourage you to design systems, because in the end, I like having lots of strategies. It makes my trading much more efficient. It prevents me from having the greed and fear effect. I just simply follow the systems, and therefore it makes me feel much more comfortable with what I do. I may not catch the exact tops and bottoms, but I'll never miss an opportunity. And at 5 o'clock in the morning, I may not be in front of my screens, but my systems are in place. They will always be monitoring and be able to trade the markets. So by having a system, there's a lot of advantages to this. So of all the strategies, what we're going to do is we're just going to select 3 of them, and we're going to combine them together, and we'll do that for multiple markets, and you'll see actually how we build out this particular portfolio. So the point is that you don't have to throw everything in the kitchen sink against a particular market and just immediately start throwing these things together. You're going to start off with your core systems, the ones that are tried and true, and then start to build out that portfolio with a selection of some other different types of strategies. But you start off with core systems, and slowly but surely you build out your portfolio as you're trying to assess its strengths and weaknesses. So let's give you an example as to what a strategy might be. These are just generic strategies, but I want to make the point between a trend, momentum, and pattern-based type system. A trend, I'm sure a lot of us have seen what an MACD crossing of the zero mark is, that we use that as our buy opportunity, and then we use some type of breakout reversal for the liquidation. 2 different styles, if you will, even though they're both trend-based. MACD indicator on the buy side or the entry side, and a breakout reversal for the exit. Of course, there would be some type of risk management, stop management in there as well. And let's just pretend that we're applying this to a 120-minute bar system, or 120-bar time frame. Our momentum-based could be used something like value charts. I wrote a book about it called Dynamic Trading Indicators. We use value charts, which is like an overbought, oversold type level indicator. And what we do is we use that as our entry, and then we use some type of a pivot, high, low, depending upon which side you're going, to unwind a position. And so if the valuation is that it's very oversold, then what you do is you go long the market, and then once the market starts to rise, hopefully it does do that, given being on the long side, market goes up, 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 then there's a pivot high, you liquidate the position. Again, slightly different strategies, but they're both momentum oriented. And let's just imagine we apply this to a daily bar time frame. I'm making the point that you can have multiple time frames and very different strategies that can be applied, in this case to gold, the symbol GC, and literally be able to have lots of different styles which you can work with. The third example, and you can have literally hundreds of these things, but the third example I'll give to you is more of a pattern-based, where it's a Gartley formation, which is Fibonacci-based strategy, and what it does is it looks for this Fibonacci projections, looks for where the Gartley would have you enter into a particular position, and you might use that as an opportunity to either enter the long side or the short side, because you can look at it both ways, and use some type of exponential moving average as the opportunity to liquidate, and apply that on a 60-minute bar system. So you can see from this real brief example that you can actually have lots of different styles. And I want you to really explore the real strengths of what Portfolio Maestro is all about, because you can then combine those together and really see how they influence one another. You'll see later on, where we talk about drawdown and the net effect of what drawdown can have on a particular portfolio. In the previous session, I spent quite a bit of time talking about where drawdowns occur, if they don't overlap, if they're spread out, then what you're going to end up getting is perhaps a higher profit without increasing the drawdown. What a lot of people do sometimes, and the reason I use this as an example, is that they pile on the same basic system and they put them all together. Well, it's not surprising that their drawdowns for very similar type systems are all going to occur essentially at the same time. So what we want to do is we want to make sure that we're building out a diverse strategy-based technology and bring them all together. I'm not going to show it, but I will mention it, that inside of Portfolio Maestro, there's actually a tool there that would allow you to do a correlation study for the individual strategies. I've got lots that are in this particular portfolio when we get to it, and it was taking up too much space, so I wasn't really going to show it. But the point is that as you start to bring these different strategies together, it's really easy to figure out which ones are highly correlated to others, and that's where you can do the mixing and matching, taking things out and replacing it with those strategies that you think by themselves might be subpar or basically average or slightly above average, but is it something that I really want to start off with? Well, maybe you do, and what you want to do is swap out those that are highly correlated to one another and introduce other strategies like these three, which are going to be very different in what they do. So with those three strategies, you can see gold up here on the left-hand side. What we want to do is that exact same process. You can use the exact same systems if you want, with different settings if you choose to, but what you can do is you can think in terms of mini portfolios now. So we did that for gold. Let's imagine we only had two systems that were appropriate and somewhat profitable on the 10-year notes, which is TY, the dark blue. And still further, we had lots of systems because euro is actually a pretty good market to trade, got nice trending qualities to it. We have 5 separate systems, each of which could be different strategies, different time frames, different stop loss logic. It's that same icon. The only difference is the red within that always relates back to the individual market that it's related to. And then the final one, RB, stands for RBOB, which is gasoline, and it's a futures contract traded out of New York. Its trading symbol is RB. Now, you take those 4 markets, and what we want to do is realize that the individual baskets for those 4 different markets are, in fact, mini portfolios. We'll evaluate each of those 4 and then look to combine them together. And that is probably one of the better ways to kind of describe what you can actually do with Portfolio Maestro. And that's the real key here. It's time consuming, yes. But it is something that is extremely important if you're going to be systematic. If you're even discretion oriented and you don't really believe in your systems, in systematizing things, you can still take your discretionary style and you can quasi kind of put it together in a system. And of course, we all know that the discretionary traders would have done it better, and they would have picked things a little bit faster than the system, because that's what discretionary traders always say. But the reality is that you can take your discretionary ideas, put it together in a quasi system. When it comes into the program, into Portfolio Maestro, it is going to be considered a strategy. So at least it would give you the opportunity to put things together. The final thing that I'll say on this, for those that are discretion oriented, you can also go in and create an indicator, buy here, sell here, on the date and time for an individual market. It is, in fact, your track record, the way you would have done it. You're a discretionary trader, and all you're doing is hard coding inside of TradeStation, buy here, sell there, buy here, sell there. Then what you do is you can import that information into Portfolio Maestro for the individual markets that you might be trading, and still go through this process and find out that discretionary style of trade for the euro doesn't seem to benefit the rest of the markets. So there's a lot of ways in which you can use it, but the simplest way is to actually design a system as what I'm describing. So having said that, the next step, and this again is all done inside of Portfolio Maestro, is to take those 4 individual baskets, combine from those separate strategies, and you're going to combine them together into the final picture. And in my case, I'm heavily influenced by gold and RBOB, less so with 10-year notes and the euro. It just happens to be where things are. But I want to at least preface that as we start to look at these numbers. When we start to apply money management in the next presentation, things will change a little bit. But this is kind of raw. Take things together, evaluate them, and throw them into a portfolio and ask the question, do I have something that's worthwhile? Do I have something that matches my personality type? Am I on the right path to creating the type of portfolio that I'm looking to create? So having said that, that will at least give you an idea as to conceptually what we do. Now what I want to do is for those of you that either have the tool or are thinking about getting it, and then you can kind of review this presentation again, I want to at least, I'm not going to show screenshots because I did that in the primer class, and it would have been too many slides and it would have been too distracting, I think. So if you were inside of Portfolio Maestro, I just want to explain to you the simple process that you go through, having described what I just did. And you can see just how few clicks it actually takes. What you would do is first, you need to create the strategy. So what you do is you go into Portfolio Maestro. On the left-hand side, there's this drop-down menu of sorts under Portfolios, and there's something called Manage Strategy Groups. What you do is you'd select that, and you would then be presented with a lot of the strategies or systems, if you will, that were inside of TradeStation. Then what you do is you take that strategy, you apply it against the time frame and the market that you're working with, and press the magic click, done. You have a strategy. For my gold strategy, for my gold mini portfolio, assume you did that 3 times. For that trend-based, the momentum-based, and the pattern-based. All you're doing is taking Maestro and having it understand what was in TradeStation, what you want to combine, and that's where the strategy is actually going to come from. So once you have those 3 strategies, for gold in my example, the next step is let's combine them together. That's what I term as a basket. Maestro doesn't use this terminology, but it's easier to describe as we build out the bigger portfolio rather than saying mini portfolio and larger portfolio. The mini portfolio for gold is, in fact, what I'll term as a basket. Now, that's pretty simple as well. What you would do is, again, on the left-hand side, if you were inside of Portfolio Maestro, you'd see something called Manage Portfolios. It happens to be the icon that's right next to the one I just talked about, Manage Strategy Groups. But this one's called Manage Portfolios. You'd select that. It would then present you with some strategies, i.e. the 3 that we saw inside of gold, the trend, momentum, and pattern-based. They would be presented there. All you do is you just simply click on those 3, and you'd be presented with the ability to click and be able to back about something that's relatively simple to create a basket or mini portfolio. Then the next step is, if you did that for both the euro, for the 10 years, and RBOB, the 4 markets that we're going to be talking about today, if you were to have gone through that same process, there was 2 for the 10-year notes, there was 5 for the euro, and I think 4 for the RBOB. You would have gone through, created those strategies that would have already been from TradeStation. You would have then combined them, each one, into 4 separate little mini baskets or mini portfolios. Once those are done, then the next step is really simple. How do we combine all four of those together? Well, what you do is you go into File, then New, and then Combine Portfolios. It doesn't have an icon. This is in the menu system. So File, New, Combine Portfolios. Select those four baskets, if you will, and then click Backtest Portfolio. It's really, really simple. And what you can do is be able to change the dates, the start, the end date, all these different things. But when I did my first presentation, the primer, I showed all of those steps, and what seemed to take an eternity really can be condensed because I was showing all the details that you go into. You can also apply money management. You can also do this and this and this. That what I wanted to show here is just how simple it really is in order to be able to create either the mini basket, and then eventually the portfolio. It really is not that many clicks, and once it's set, the maintenance and the review of it on a regular basis is quite easy. So as I've said, just in case there's futures traders, and I do want to preface, and I should have said this initially, I am a CTA with a firm called Capital Logics. We're based out of Dallas. We're systematic in our style, and obviously I'm going to focus on the future side. Everything I'm talking about is just as easy to do with ETFs and or stocks. So I've got Euro, I've got 10-year notes, I've got gold, and I've got RBOB across four different sectors: currencies, interest rates, metals, and energies. But you could just as easily replace that with four different stocks or four different ETFs. The point being, as I mentioned in one of the previous presentations, it's very important in the selection of the individual markets, which ones am I going to bring together? Now, I'm big on Twitter, and I put a lot of information out there. And if you were to trade a diversified basket, really, what do you have? I've got the S&P. Okay, what else do you have? I've got the Dow Jones, the NASDAQ. Really? All those markets, those three markets are highly correlated, no matter what you look at. If you look at weekly, monthly correlations, long spans, short spans, they're virtually the same. The importance of me making this point with these four different markets is to emphasize when you build a portfolio and you're going to create this thing, if you have similar markets and you've gone through this entire process that I'm describing, but you basically have the same markets in there, S&P, Dow Jones, and NASDAQ, don't be surprised if your drawdowns all occur in the same spot, even despite the fact that you might have different trading styles. Now, could you do it? Of course you could. The object, though, and I think that the strongest element here is that what you want is to be able to have something in place where you have very different markets. So if you're ever interested, I'll put a link eventually up here, and I do correlations for 40 different markets against 40 different markets. So it's a 40 by 40. I do it for both the monthlies and the weeklies. It's 3,200 slides or 3,200 charts. But if ever you want to do deep analyses, I've got the information. I showed that in the previous presentation. So we've gone through this process. We create and put all these things together. And once you are inside of Portfolio Maestro, what you want to do is run the back test. You're going to be presented similar to what you get inside of TradeStation right now, the evaluation report. And what I want to do is make sure that you understand that there's all sorts of tabs and a lot of information. And a lot of it isn't redundant, but it just sort of organizes it in a slightly different way. What I want to do is I want to focus on the three tabs: the summary, the trade analysis, and the graphs, the visuals, the charts, the graphs, those types of things. And so I'm not going to really deviate too much from that, but I'm going to at least show you some of the tools that you can actually have access to. So we do all of this. What are some of the more important evaluation tools? Now, this is going to be found primarily under the summary tab, where we're looking at the portfolio, not the individual baskets. I'll show you how to do that as well. But what you want to do is you want to sort of focus on the portfolio. And what I've got listed here are 6 different items. 2 of them are good for the individual baskets, but I wouldn't say that they're good for the big portfolio. 3 of them are somewhat redundant to one another, and I'll tell you which one I like the best. And then you have maximum drawdown, which is just a really good risk metric. So let me just say this. Profit factor That's nothing more than gross profit over gross loss. It's good. A lot of people use it. When you start to put this into a larger portfolio, it starts to lose something. It becomes diluted. So profit factor and average wins to average loss, and its formula is pretty simple, average wins divided by average loss. Those first two, profit factor and average wins to average loss, in both of those instances, I believe that they're better used if you review them and use them at the basket level. Again, when you start putting a lot of things together, you start to dilute them. So profit factor and average wins to average loss just for gold, just for RBOB, just for 10 years, just for euro, then it makes more sense. Then when you combine those four together into a larger portfolio, it's important, they're both good numbers, but they become a little diluted and I wouldn't give them as much emphasis. Flip side, what I would be looking at when I combine the portfolio, the Sharpe ratio, the K ratio, and the return retracement ratio. In that particular case, they're all very similar. Most people know what the Sharpe ratio is, but for those of us that trade commodities and those of us that are trend-based, the Sharpe ratio penalizes you for really good performance. And so what ends up happening is that we can have $10,000 profit, $10,000 profit, $10,000 profit month after month after month, and then miraculously everything falls together and we make $500,000. Our Sharpe ratio would be penalized for having made more money than normal, and therefore the Sharpe ratio isn't necessarily the best tool, especially if you're trend oriented. Is it good? Is it valid? Of course it is, but just understand its weakness. The K ratio, the K stands for Lars Kessner. Excuse me, Lars Kessner. When I helped deal with RENA systems way back in the early 90s, we put that particular tool in there. So you can find information about the Lars Kessner and the K ratio. There's information out there from Stocks and Commodities magazine, just if you want more information. But I'm not going to go through the formula itself, but the K ratio is similar to that of the Sharpe ratio, but it doesn't penalize you as much for the increased profitability that you might have on a month-to-month basis. Along the same lines, the return retracement ratio, another one of my favorites that we put in, that comes from Schwager in one of his books. You can do a Google search on it as well. But I guess the best way to phrase it is that Sharpe is popular. Most people know of it. But less known, but probably better tools, the K ratio and the return retracement. I'm going to use the return retracement as the one number, but they're all equally good, and they all basically say the same thing. But nonetheless, I'm sure you'll find your favorite based upon the way you want to do it. The final one is maximum drawdown. That's the peak price, profit, if you will, to the lowest subsequent price or loss. And we look at that as the maximum drawdown. I'm sure most of you know that, but just in case, I just want to point that out. So let's get to it. What we have here are the four markets, Euro 10 years, gold, and gasoline, RBOB gasoline. We have the symbols just in case you want. Then we have the profit factor. Looking at a profit factor, obviously above 1, approaching 2 is better, but sometimes people look at their profit factor and they get a profit factor of 8. I used to evaluate a lot of systems, and these people would come to me with these huge profit factors, and to the same extent, average wins to average loss. And I always say the same thing. If it's too good to be true, then there's probably a red flag. So around 2 is a good number. You want it above 1 as a minimum for the profit factor. And for the average wins to average loss, personal preference, I like it above 2. So you can see that the individual baskets, that the numbers are actually pretty good. I'll get into the, R is similar to MAR and the CalMAR ratio. Now, when it comes to the Sharpe ratio, K ratio, and return retracement, those tools, I think, as I mentioned before, are a little bit better when we start dealing with the individual basket and combining them into a portfolio. And I showed the basket average, specifically for the Sharpe, K ratio, and return retracement. so that you can understand that when you put together a portfolio, you say, "Hi, I don't need Portfolio or Maestro. What I need is just to combine them together. I'll just take an average." And I point this out that when you take an average, as opposed to truly taking the raw data, which is what Maestro does, you take the raw data and it recompiles it together to create a real equity curve, which is kind of the building block, a trade by trade list, if you, which is the building block to all of these formulas. What you'll see is that the numbers between the average, it should be pretty obvious, but the average versus the portfolio are going to be different, because an average is just an average. A reconstructed equity stream, by combining them together, is obviously going to get you a different equity curve and therefore different numbers. And I point that out because some people don't always seem to recognize that, and they say, why do I need the program? Because you need to have accurate numbers if you're going to put things together. An average is nothing more than an average, and it doesn't really tell you that much. I do want to point this out specifically for like the return retracement ratio. The numbers that you see there, the high point is 4.36, the low point is 1.1, and the average is 2.9. When you combine it together within the portfolio, all of a sudden the return retracement ratio goes up to 6.8. One of the key things that you can be looking at, both for Sharp K and return retracement, they all basically say the same thing. What you want is for those particular tools to show a synergy, show that the individual elements are better by having put them into a portfolio. That's not a hard and fast rule, but it's pretty obvious that if you're able to combine lots of things together and the whole is better than the sum of the parts, then in that particular instance, you're going to get something that's better and better. And if you choose to add or delete strategies, add or delete markets, whatever the case is, one of the key things you can look at is going to be some of these types of tools. Am I, in fact, making things better? Therefore, sometimes, in fact, I'll shoot you an email or I'll shoot you a link here to an article that if you have the drawdowns all occurring at the same time, you're going to have a massive drawdown. It's okay to have two different drawdowns. In fact, gold and gasoline had 43 and 42% drawdowns. And the good thing is that they didn't both occur at the same time, and they offset one another. And when we look at the portfolio, yes, the drawdown is 27%, but the reality is that you're dealing with something that's a better tool. The maximum drawdown did in fact go down. Did I make more money? According to the risk-reward ratios, yes, I did. Based upon just a risk metric, maximum drawdown, yes, I'm doing better. And what I'll point out is that maximum drawdown is nothing more than just a point in time from max point to the low point, and it tells you on a percent basis how much you lost. Those maximum drawdown numbers, I should have put percentages in there, but the percentage is just a point in time. I like other tools as well, but for our purposes, you want to focus a lot on the limitations of what the portfolio can do, and at the same time be able to go through the process of being able to look at what kind of risk am I actually involved with. Am I in fact making the portfolio better, or am I making it worse? And I guess I'll come back to the point I made earlier. S&P, NASDAQ, and Dow Jones all together, chances are you're going to have some of those types of scenarios where the drawdowns are all going to be at the exact same spot. So I'll just show you a couple of quick little charts here. Hard to read, it's a little bit small, I realize, but we've got the euro, the 10-year, gold, and gasoline, which are the blue bars on the left-hand side. This for the Sharpe ratio. I put the average in the gray, and then the portfolio in the black on the far right. And what you're always trying to do is the portfolios better than the majority of, it's not always going to be all of them, but the majority of the individual elements that make up the particular baskets of the portfolio. And in this case, yes, according to Sharpe, and you'll see for the most part that they all kind of do the same thing. That's why you don't have to go into each one of them. You just simply select the one that you feel most comfortable with. I like the K ratio better than the Sharpe ratio, and it shows that same type of scenario. And then when it comes to the return retracement, which is one of my favorites, it also shows the exact same scenario, that the 4 individual baskets by themselves have a better portfolio return retracement. Therefore, you feel that you're moving in the right direction in the construction of the portfolio. The final one here is looking at drawdown. Now, I mentioned before that we had hefty drawdowns in gold and inside of gasoline, RBOB gasoline. And the saving grace is that the euro and the 10 years had drawdowns in different areas, as did gold, separate from that of RBOB gasoline. So it comes down to personal preference. But in looking at the drawdown for the portfolio, is this something that you can manage? Is it something that you like, or is it something you don't like? If you're a conservative trader at 27%, maybe you don't. Well, that's when you have to mix and match things a little bit better to sort of fit your personality type. But again, Maestro really sets this thing up so that you have more information to which to work from, and it's a real easy process of clicking a button and updating it for the next day and rearranging the dates and really getting everything set the way you like. So in this particular case, some of the other primary tools, I broke them down to primary tools and secondary tools. The other primary tools is total return. So in this case, it makes 1.8 million. The CAGR, compounded annual growth rate, is 80%. A little unrealistic because of the fact that I've got a heavy influence into very strong markets. We'll adjust this and be able to play games with it when we start playing with the money management side of things. But for our purposes, the CAGR for that 27% drawdown, the CAGR is 80.18%. Average monthly return, another easy number to calculate, and it's inside of Maestro, is the average monthly return. In this case, almost 6%. Under the primary tools, understand this because I'm going to make a distinction. This is percent profitable based on days, weeks, and years. This isn't percent profitable based upon trading, looking at how many winning trades and losing trades. This is percent profitable. And this is a good tool to give a person some perspective as to how good or how bad your particular portfolio is. What kind of personality type does it actually have? And certain people say, well, I should make money every single day. Well, in this case, this is not the portfolio for you. It only makes money 43% of the time on a daily basis. I think it's supposed to be not weeks. I think that's supposed to be months. I think I have a typo there. So 67.2% of the months are profitable. Years, it breaks down to 100%. So over the course of the year, for this particular portfolio, it's always been profitable. The days, hey, 50-50, well, 43% actually. On the months, not every month is going to be profitable. And people need to understand that. As a person that invests with people and things of that nature, I have to tell people what kind of a personality type portfolio do we actually have. If you have expectations that you're going to make money every single day, I'm going to steer you towards a CD and not an alternative investment CTA type program. So it just goes to show that it gives you some perspective as to what's actually taking place. Maximum drawdown, this on a monthly basis, peak to valley. We'll look at a chart here in a little bit, but it's still important. You should expect some type of a drawdown. In fact, some people take their drawdown and they multiply by 1.5 or 2. So there can be heavy drawdowns into the future. We'll clean things up when we start dealing with the money management side of things. But the reality is that something that you can handle? Well, I thought we'd only have like a 5% drawdown. Well, this is not the program for you then. This is not the portfolio. So moving forward, somebody had mentioned MAR. MAR is nothing more than CAGR divided by maximum drawdown. There's different styles to it. CalMAR, as the person noted, it just simply goes over the last 36 months. So MAR is a good tool. It's not necessarily in the program, but the tools are there. So you have CAGR divided by drawdown, and you get 2.92. And in that particular case, it's a good little risk-reward type calculation that helps to sort of get a feel for what kind of a portfolio you actually have. Now, the secondary tools, these are ones that people often quote, but aren't necessarily the best. They're kind of warm and fuzzy type things, but sometimes they're taken out of context. In this particular case, percent profitable, 35% of the time between when you get into a position, 35% of the time you're going to have a winning trade. Well, some people think you should always win all of the time. Sometimes they give a greater emphasis to winning trades. The reality is that if you have a great emphasis specifically on trend-based, it means that you're betting that you're going to get a trend and you're going to stick with it and let the profits run. And when that doesn't work in your favor, as I mentioned long ago in the presentation about stop management, you're going to liquidate your positions. So you can have loss after loss after loss after loss. In fact, further down here, you can see we had 62 losses in a row at the maximum. So you can have 62 trades in a row that were losses. But the reality is that, I'll use the analogy, I lose $1 every time. And when I do finally get the big winning trade, I can make $100 and erase that. So don't put a lot of emphasis on the percent profitable trades. Give greater emphasis to what I showed in the previous one. We were looking at days and months and years. So percent profitable is what I would definitely consider to be definitely a sub-tier or second-tier type calculation. Total trades, obviously, it's important. 14,000 trades. TradeStation would love this for your portfolio. Average length of a trade is 1.92 days. Now, one of the nice things about Portfolio Maestro is that it has the ability to go there and sort of separate the individual markets and be able to look at what is the average holding period for the individual systems, or in this case, the individual markets. So the average length in this case, we'll call it 2 days. But for RBOB, it's 18 hours. For gold, it's 2.5 days. For the 10 years, it's 11 days. And for euro, it's almost 4 days. So that being the case, what you can do is just get a feel for how long you're actually in trades and be able to go through the process of getting a really good feel for what kind of a portfolio am I constructing. You might want to look at those on the individual baskets and then compare it against the portfolio, but in the end, you're going to want to know the personality type that you're dealing with. As I mentioned before, consecutive wins, 18 in a row. Consecutive losses, 62. Again, personal preference. Could you handle that? A lot of people can't. You know, I've had 3 losing trades in a row. I mean, the sky is falling. Well, the reality is that you should expect, especially at a portfolio level, to have that many types of losses in a row. It's going to happen, especially the more that you do when it comes to the actual portfolio. And then total commissions, $70,000 over the course of this 6-year time period, I think it is. I'm not sure exactly what it is. I'd have to take a look. But whatever the case is, you know, take a look at the commissions and understand what your broker's making, and you know, it's actually in there. The reason I put that in there is that I typically will always look at commissions and slippage, which there's a user-defined section inside of Maestro that would allow you to obviously put that in there. And what you want to, at least what I do, is I always increase it fairly dramatically so that I have the ability to dumb down my numbers so that commissions and slippage don't have a major influence on my assessment. In fact, I want to dumb it down enough so that I feel comfortable that the commissions will never hurt me and that the slippage, and it happens, that's when you get into a trade hypothetically, but then the market moves a little bit and then you get into your position. So it's very important that you apply both commissions and slippage. And in this case, that was just the commission tool, or the commission number. Now, having said that, numbers are important. However, what you want to do is, at least what I always do, is I'll look at some of those key primary numbers, and then I'll immediately switch to some of the charts. And so what we'll do is we'll look at VAMI, Value Added Monthly Index, month to return to month drawdown, underwater equity curve, which I'll spend some time on, weekly return, total distribution by the symbol based on profit, contribution by symbol, and then symbol equity curves. So those things will give you some visual perspective on what's actually taking place. There's just a couple that I primarily look at. This is the first one. It's the Value Added Monthly Index. The reason that this is important is that it gives you the opportunity to say, if I invested $1,000 at the very beginning, what would my portfolio have created at the end of it? You get past all the garbage of millions and millions of dollars and things of that nature, and you can boil this down to a VAMI type chart, which allows you to very easily compare one against another. And what you want to do is you want to be able to have these things normalized. So you can look at the individual VAMIs for the individual baskets and then ultimately into the portfolio. So it's a good thing to look at. I think a lot of people bypass this because I just want to know how much money I made. What you're looking at is the construction, the smoothness of this. And for some of you that want more numbers, what you can do is inside of Maestro is that you can click and you can export this information and you can run R squared on it, something of that nature. So you can do an awful lot with this information, but one of the primary ones is definitely the VAMI. This one will give you some perspective, and I point this out because there's a deficiency here. The monthly return, which is in blue, and the monthly drawdown, which is in red, and you can see that the numbers are wider in the beginning and really small at the end on the far right, and that's because we haven't applied any money management to this year portfolio. It's really just the stepping stone to our next presentation, but it allows you to very quickly bring things together and get an idea. Do I have what is the beginnings of a good portfolio or not? And that's really the intention here. So all you're really trying to do is hopefully you have higher blue bars than the red bars beneath. This is the chart that kind of shows that same information, and it's kind of a precursor. The other one's a precursor to this. This is the underwater equity curve. Again, it came. We put it into the program at RENA, which eventually came into TradeStation. Is the underwater equity? It comes from the Schwager book, and what it does is it shows. You see these black bars here on the left-hand side. That shows that there was new equity high. Another month. This is monthly information. The next month, new equity high. Next month, the new equity high. You don't start seeing red until you start losing money. From whatever your previous equity high was, there's some form of a drawdown. And then there might be some type of recovery, and then another drawdown. And what this is essentially showing you is the magnitude of the drawdown, which is what maximum drawdown is, but it also, in a visual side, shows you the duration of the drawdown. So it's not just one-dimensional from peak to valley. What this is showing you is how long were you in the drawdown. And I often use the example of if you're in a drawdown of 5%, a person might say, I can handle that. But if you're in that drawdown for 3 years, could you handle it? Well, no. Would you rather have a 10% drawdown, but it only lasted a month? Well, in that be your case, you might want to take the 10% drawdown as opposed to the shorter drawdown. So it's a really good, it's kind of like the Ulcer Index. Here's a quick little thing that you can go to, and it talks about the underwater equity curve a little bit further. Here's a weekly chart of distribution. I put the yellow mark in there. It kind of shows the 0 mark. Obviously, what you're looking for in a perfect scenario is a lot of things are going to be in around the 0 mark. That's probably going to be pretty obvious. But what you're looking for is some of those big months where you can make up for a lot of the small losses. And so in that example, what we have is a little distribution that will really at least give you an idea on a weekly basis. I think you can do it on a daily and monthly as well. I choose the weekly just to get some different perspective and see what kind of a distribution we might have. You can also break things down via the individual systems. You can see that a large part of this profit is coming from 2 symbols, gold and RBOB, and lesser in the euro and the 10-year notes. And just a matter of just mixing and matching and start to apply some money management, which we'll do next time to sort of normalize things. This is very small, I realize, but this is nothing more than a pie chart at the same numbers that I showed early on, where we had a large emphasis at this bigger point in gold and RBOB and lesser in the euro and the 10 years. It gives perspective so that you don't have, wow, 10 years are really hurting me or down, and you give too much emphasis to it. Are you kidding me? It's gold and RBOB that you should be focused on more so than the euro and the 10 years. This last one, which is extremely small, but it shows up much better if you have the computer program in front of you, that Maestro will show you the individual equity curves for the 4 separate mini baskets or mini portfolios. So it really does go through the steps of being able to show you as much information as you possibly can, and does it in a really good visual type perspective. This last chart that I want to show you is kind of a synopsis as to the process that you go through, as I'm running low on time here. That what you're doing is you have a funnel. You have the Euro, 10-year, gold, and RBOB, and you bring them in. And what you want to do is you want to assemble as many non-correlated markets as you possibly can. That was the last presentation I went through. You could obviously have a lot more in there, but it's biased based upon what kind of capital you have to start with. So you start with as much as you possibly can, always working towards more diversification across markets and systems. But you start off with as many non-correlated markets as you can for diversification purposes. Then you apply your systems and you apply the trade signals, which gives you the opportunity to sometimes trade 24/7 and be able to find yourself constantly looking at all the different markets and taking advantage of signals that may occur early in the morning or late at night. But you have the ability to systematize this and put it into place. The next level is applying money management to give balance, which is what we're going to be talking about in the next presentation. Risk management. Risk management could either be stops or risk management. In my case, I'm talking about risk management at the portfolio level, where you can put stops in the portfolio, which again we'll talk about in the next presentation. My feeling is that if you have all those systems and you have the ability to manage all of those trades, you don't need a lot of people in your firm or for yourself to be able to manage a lot of different types of markets. So the trade execution, it's really simple. We do it through TradeStation ourselves. We're 100% systematic, and you're welcome to give me a call and answer questions for you. But you have the execution, and what it does is it gives you discipline. So you're not saying, I think I'll do this, or maybe I won't do it. Baloney. If it's your strategy and it's something that you want, for every time I was 100% convinced the market was going to do something, it failed. And I can pretty much say that every time that I thought the market was going to go against me, that's the time that the market did really well for me. I'm no different from a lot of other people, and I need the discipline of the systems. So that's what will happen with this entire process. And then the final step is that you're allowed then to oversee the difference and reconcile between what TradeStation, the program, says versus what you might get inside of your broker statement from TradeStation. So it allows you to compare things. Do I need to add more slippage, more commission to my style? Is there something that a market that's not reacting all that well? And it allows you to reconcile and really get the confidence that you need in order to follow this entire process. So hopefully by going through this and seeing what you can do with all of these individual markets and combining them together, you have the ability to truly be able to construct a really strong portfolio, one that matches your personality type, by looking at these evaluation type tools, getting a feel for what's good, what's bad, so that you can mix and match and get rid of certain strategies, certain types of markets, add other markets that you might not normally trade. And again, the last presentation, I would try to make the point, where can you find those types of markets and what would necessarily fit within an existing portfolio? It's that type of a process that this is forever evolving. It is never stagnant. It's dynamic because you're constantly adding and deleting things as necessary in and around your core portfolio, and then adding other types of systems into the mixture. So I'm about out of time, and I apologize. I plan to leave more time for questions. I have my contact information there. You're more than welcome to give me a call. Sometimes during trading hours, if I can talk, I'll talk. If I can't, I'll just make an appointment to talk at another time. You've got my email. You can ask questions there. I don't really like people ask, simple questions, but it would take me 3 pages to really answer it correctly. So I actually prefer to talk it rather than type it. If you want to track me, you can watch me on Twitter. I put a lot of information out there. You're welcome to go to my LinkedIn account if you want to link to me there. I put some information out there that I don't always put on Twitter. And then you're welcome to go to capitallogics.com. I mentioned that we have a lot of tools on that particular website that do a lot of correlations, seasonal type things, some risk reward type calculations, comparing different markets. It's a really good starting point that if you're trying to figure out what markets to trade, here's a good starting point. I know I want to trade this market. What fits well with it? That's what those tools are really all about. So with that, I'm going to say thank you. And as I said, if there are additional questions that you might have, just let me know after the fact, and I'll try to answer those questions when I'm able. Thank you so much.
Thank you very much, David. That was great. Thank you, everybody, for attending. In the chat is the link to register for the next event, along with the on-demand archive videos of the first two sessions. This session will be up in a few days. Please take a couple of minutes to click and take our survey. It's about 20 seconds, so that helps us improve these presentations. So again, outstanding presentation, David. Thank you very much. We'll see you on the 17th for the final installment of this series. And thank you, everybody. Have a good evening, and we'll see you at a new event coming up. Thank you.